We're snorting cap rates and shooting up cash flow here at Deal Junkies.
Welcome back to Deal Junkies.
Come on, Mike.
Was that not good?
More energy.
Was that not good?
You can give it some. Right. Give it some.
We're in the studio. That's in my studio. We got Dave Johansson, Trevor Howard, and my great friend Tarl Yarber. Now out of Austin, no longer Seattle. You were a Seattle junkie when I first met you, but he is the master of scale. Can we call you the king of scale?
Scaling up and down.
Scaling up and down? You have scaled down, haven't you?
Yes, sir.
Yeah.
We can get into that if you want.
What's that?
I said we can get into that if you want later.
Yeah, definitely. So I met Tarl right before he had started Fixated Real Estate. So he's a founder of Fixated on Real Estate. He did events in Seattle, larger events since with Brandon Turner. He has the Limitless Expo coming up soon. He's flipped over 600 homes. He loves the BRRRR strategy. He is best friends with Jay Scott, which just makes him cool in everybody's book. And he's all about real estate. He's all about connecting people. He's probably one of the best networkers I know. True story. We were in a broker meeting. This must have been 2019. And we in-person broker meetings, there's like 15 around our conference table. And I get this text from Tarl and he's like, Mastermind in Maui, we have 2 spots. You need to let me know in an hour. And I responded immediately. I was like, we're in. And that was a kind of a changing moment for me. I appreciate it because it really opened me to more national people and people outside of Portland and kind of getting out of my little box. So I'm sure you've done that for a lot of people.
Are you still lending too?
Still have a hard money lending company. And Mike, thanks for the intro and thanks for the friendship over the years for sure. But yep, we still have a hard money lending company, a real estate business, and an events conference company as well.
Okay, because I think when I met you in Maui, you were really starting to scale the events business. And now, I don't know if you had done a Limitless yet at that point.
Depends what year it was. First Limitless was 2022.
Okay, yeah, so I think it was before that.
Yep, I'm actually in the hotel right now of the first Limitless. And Limitless was exactly June 10th of 2022, so we just passed the anniversary. So. And
you just had one last month too, right?
No, Limitless is actually this year, August 14th through the 16th.
What was the one you did a month or two ago?
We did the REI Summit in
Okay.
April. Yeah, over in Austin, Texas. So there are about 750 people at that one.
Okay, right on. Yeah, I love going to those things. They're so much fun.
What took you from Seattle to Austin?
Oh, sure, no problem. So the year was 2020, and we moved to Maui. And then after 13 months in Maui, I asked my wife if she wants to go back to Seattle, and she said no. And so we had to figure out somewhere else to go. So I grew up in California. It wasn't going to be California. And basically, we just kept going east, and we ended up in Texas. So the long story of it is that I went to an event in Vegas, and some random person said, you should check out Dripping Springs if you look at Austin. So I said, okay. And then we spent 2 weeks in Dripping Springs, bought a house, and moved there. Literally, that's all we did.
What made you want to leave Maui? Isn't that the spot to be?
Maui, we actually, during COVID, Seattle shut down. We actually flew out to Boise to have dinner one time, I remember. And we usually would travel. My wife and I would usually spend between 5 to 7 months a year traveling. And we couldn't travel. So we said, all right, well, let's go visit our friends in Maui for 6 months instead. And so we rented a house there for an extended stay for 6 months, and then we just extended the stay. So we were never actually going to move there. We just didn't leave.
Just a really long vacation.
Yeah, 13-month vacation basically. Yeah.
Cool. Well, take us back. I don't know you, Tarl. I've heard about you. Jay Scott speaks very highly of you. Can you take us back and tell us a little bit about yourself and how you got started in real estate?
Yeah, sure, no problem. So in 2005, I bought a course. I was 20 years old. It was called How to Turn $10 into $10,000 in 30 days or less. And it was about wholesaling real estate. There was no actual in-person meeting. It was just books and CDs and stuff at a sell-a-thon. The only reason why I bought that course was because I bought a different course at the sell-a-thon about, it was called The Turning Point by this guy, Marshall Silver. It was all about how to become a millionaire mentally, right, kind of a thing. I was 20 and I didn't want to be broke. Rich Dad Poor Dad was there. Robert Kiyosaki, Tony Robbins was at this conference. It was a big thing in 2005 in LA. So I bought the psychology type mental become successful subconscious reprogramming course, and I didn't have the money. So I was like, all right, well, I have a charge card. I got 30 days to pay this thing off. It was $1,500. So I need money. So how am I going to do that? Oh, look, a course that says how to take $10 into $10,000 in 30 days or less. I got $10. Let's go. Right. So that was $900. So it was a wholesale real estate course. So I bought that, didn't know crap. But I had extreme urgency as a 20-year-old kid trying to figure out how to make it work so I don't get into credit card default. And it didn't work for me until 6 months later. So I did get into credit card default. I did pull out all my cash advances. I did burn all the boats. I did stop paying. And I dropped out of college too, and pissed off everybody. And then just started door knocking at 20, in basically 110-degree heat in Sacramento, California. Just like, I literally would cry in my car. Like, I would be terrified trying to like knock on these doors, trying to see if somebody's in default and if they want to sell me their house. Didn't know shit. So, but I did what the book said. And then eventually it turned into a first deal. Then the third deal turned into $100,000 co-assign or double escrow. And that was my last deal, which was 2006 until 2010 when I got back into real estate up in Seattle. So
you took the 100K and you left. You said, I'm out. You bounced.
I'm out. I hated every minute of it, every second of it.
That's hilarious.
Like
the money didn't change your mind.
Not at all. It immediately made me stop. Like, so right away. Immediately. And also it was good timing because it was like mid 2006. So not too long after that, shit hit the fan. So, but I didn't even understand that stuff. So when I'm 21 and everybody's like, oh my God, the world's falling apart. I'm like, I don't get it. Whatever. So, and in 2010, I moved up to Seattle. And by 2011, I was full-time flipping houses. So, and there's a whole story there, but did that for years. And by, say, 2016-ish, 500 plus houses by the time I got to that. And then I slowed down. Actually, 2017 is probably 500 houses. But I started slowing down a bit. And then I ended in 2022 in Seattle and shut the business down after the rates changed. And I moved to Texas and didn't start buying again until 2024. Started buying in Savannah, Georgia, and Arkansas, and now Texas. I still have my portfolio up in the Seattle Pacific Northwest area, and we still maintain that portfolio, but I don't actively buy up in your guys' neck of the woods anymore.
So were you doing buy and holds as you were flipping during that time period?
Smart people would have, but I didn't get my first rental till 2016, and I bought 3 rentals 2016. They were actually BRRRRs, and the first one I still own, and I went to closing, and if I remember correctly, it was like $6,700 or $7,600 was owed at closing for the BRRRR. So I was so in my head as a house flipper for years, I was having to put money into escrow to refi, or to me, close the house. Mm-hmm. And I actually thought I was losing money. And I felt like, I'm not even kidding. Like, I remember just telling my wife, like, I'm going to cancel the whole transaction. This is BS. We should be selling this thing. And the thing was cash flowing over $600 a month at that. I just like 7,000, something like that for cash left into the deal, but it was cash flowing $600 a month. So it's a fantastic freaking deal. Still the best BRRRR I've ever had, right? As far as like to this day, like I've split a lot on it. The lot's worth 180 right now. Like I've done all sorts of stuff. Property's worth, I don't know, 700 currently, something like that. And I bought it for 110, so it's like, I'm just an idiot. I should have kept more properties as time went on. But Mike, I can't remember when you got started in REO. How long ago did you get started?
I made the transition in 2009, 2010. And then I think you and I met like 2014, 2016, right? I remember talking to you about BRRRRs and this exact story. Because it's a mind shift to go to that follow-up closing and write a check rather than bring a check away from it, take a check away.
Correct. And then I remember now, and you would also know that getting capital to keep a property back in 2010 2011 was like just not a thing,
Mm-hmm.
especially as an investor. And so even hard money loans were like what 4.16%, 5 months, 6 month terms, like
Yeah.
with a re-up of another 2 to 3 points. Like it was just ridiculous. And you maybe a max LTC of 70 to 80%. I mean, 80% would have been like amazing, but most of the time it'd be like 70+% for LTC. And it was ridiculous. So like getting just like multifamily right now, which I don't want to get diverted. Multifamily has a whole bunch of deals because a lot of it's crashing, but good luck getting funding right on those deals. That was the same thing with single family back then is, you have all these properties, but you have no idea they're deals until 7 years later, and you couldn't get funding anyways. So during that time period.
Yeah, the ones that were successful back then were the people that were able to put together stacks of capital through a fund, and
Correct.
they were buying large at scale in a marketplace and creating a portfolio in an area. Yeah.
Correct.
You had to have
Absolutely.
equity. Yeah.
So how many of those?
That was-
How many of those 500 do you think you could have held as Burrs?
Oh, back then, all of them, every single one. So, without a doubt, right?
Just think if you didn't need to eat and go on vacation and
Well,
ski and
Yeah.
I mean, even on that Burr you did where you had to leave 7,600 in, like you would have saved more on taxes just through depreciation because you have high income at that point.
Listen, house flippers don't know anything you just said and what it means. So, and I can promise you right now, I was like, what is depreciation back in 2016?
takes
No
a while to
clue.
evolve beyond a blunt object and into actual
Oh, for sure.
sophistication. When
It's
did you start
ridiculous.
getting sophisticated? So the Burr is the kind of the first process, but you're much more sophisticated than that now.
Correct. No, like that actually was a triggering time and a pivot when all of a sudden we had 3 rentals at the end of 2016. And I'm like, wait, this is kind of cool. Right. And then we started buying more in 2017 and 18 and 19, and just basically shifted pure Burr strategy by 2018. Even to this day, all the projects I'm bought in Austin right now, they're all Burrs, every single one of them. All the Savannah deals, except for there's 2 that are Burrs now. They were supposed to be flips. We can talk about that. But there's a couple more, and there's 2 more in Arkansas that are now Burrs, but they were supposed to be flips. But essentially the transition really started coming with keeping the properties and realizing how you get better capital these ways, how you get better financing these ways. Hey, banks look at you a little more seriously this way. Now you have more collateral. A big thing for me was in 2017, we had started our events company. And Mike, I think you went to my first expo in 2017. Yeah. And it was called the Big Badass Real Estate World Expo in Seattle. We had 510 people at it. But we made 30 grand total, like revenue in the events company in 2017, like revenue, right? And I went to the bank, my bank, and I wanted to get a line of credit on my real estate company that did millions of dollars every year, like millions, and not revenue. I mean like net. And they wouldn't give me anything because I was a house flipper. It was like, that's not a real business. And then they literally looked at my events company that just did 30K for the year. And they're like, we'll give you 300 grand on that one.
So
I'm like, what are you talking about? And I remember like, just like laughing like at this meeting. I was like, are you kidding me right now? Like that business sucks. This business been around for a while. And it was just kind of woke me up to like, the stability of how house flipping is versus like how a real business is, and buying rentals and keeping rentals is more like a real, in a sense, like a real investment, for like a better word. But I don't know where I was going with that, but that's when I started transitioning into becoming smarter. So when it comes to business, money, finance, all that stuff.
So if you went back, would you have changed anything in those timelines? Would you have held more or switched strategies earlier on?
How much time do you got? So the hindsight investing is not healthy. Let's just put it that way. So like going down the rabbit hole of hindsight, especially as a house flipper, is not like a good time. So, but ultimately, I didn't know anything, dude. Like in 2010, 2011, 2012, 2013, I had a partnership with me and 2 dudes, and none of us knew anything. We just knew how to get properties, right? That's all we knew. And we knew that if we bought it, we can either, at the time, there was the whole Invitation Homes and all the funds were new. They were like brand new. Nobody really thought anything of it at the time. And so we would like sometimes flip them to them and make like 6 grand, 7 grand and be like, woohoo, but we're doing like just chunks of these things. And then we'd sometimes buy them and flip them and make 15, 20 and be like, yeah, right. And just keep going. And we weren't thinking of anything else other than that. And so Now, hindsight, looking backwards, we're like, yeah, we should have kept everything. Yeah, we should have at least kept one out of every 5 or something. And if we did, my net worth at least would be tens and tens and tens of millions of dollars higher than it is already. So like, it's just ridiculous. So absolutely, I would have totally changed a ton of stuff. Plus some of the relationships, plus the stresses. Like, this is something that, a problem I had back then would have been, a problem that I had back then is like a Monday today, right? Kind of a thing. It's just like, the problems back then like derailed me, like just debilitated me, because I was so stressed. I was so new, right, to everything, that if a contractor or whatever didn't show up to a job, like, it was just a big issue, right? But today it's just like, whatever, that's normal. I can go on and on. I don't want to keep ranting. Sorry.
Yeah, your personality's been ground down over the years of like what you said. It's just normal now. You're yeah, exactly. You become callous to that operandum.
Well, this is the first time. This is the first time I've seen you not wearing your discipline shirt.
I'm wearing a Limitless t-shirt.
Limitless.
Limitless Expo. Go to limitlessexpo.com. Check it out.
So rumor has it you're an extreme personality. Is that true? I heard you're a Jocko fan and you're just all into some crazy stuff. Talk about that a little bit.
I wouldn't say I'm an extreme personality. I like extreme sports. I'm naturally introverted, so but I would definitely say that, yeah, I'm a big fan of Jocko Willink and so forth. I've been a ski patroller, or was a ski patroller until I moved to Texas for a long time. Snowboard for the last 30 years. All the skydiving, rock climbing. Just love extreme sports and that kind of stuff. If that's what you mean, or if it's more along the lines.
Adrenaline junkie.
But more than just adrenaline, like the talk about the discipline aspect of your personality.
Yeah, so maybe I would say that I wanted to be more disciplined, so I gravitated towards Jocko Willink and his book Extreme Ownership, and that book really called to me in a lot of ways. When I first read it, I heard Jocko Willink on Tim Ferriss for the first time, and so I immediately picked it up and thought it was just the right time, right place for all of it. It was 2016 when he started coming into the scene. And I got pretty obsessed with him and his whole ecosystem with what he does. I've been to a bunch of his stuff. And then because of him, actually, this is something that I am pretty proud of. Our events company has never really been like a profitable, it's made money, but it's never really been the main purpose of the events company. Is that the main purpose for the events company has actually just been like for connection, meeting cool people, having a good time because we could do it. And business-wise, now this has to do with Jocko, by the way. Business-wise, it houses all our W-tours. It has all. There's a reason for it. It's a really good structure for us financially. But the biggest thing we've done with it is we do a lot of charity stuff with it. So, and that charity stuff started because of listening to the Jocko podcast. He had a guy on his podcast named Travis Mills. And Travis Mills is a quadruple amputee, and he lost his legs and both his arms in IED while he was in Iraq. And he started a foundation called the Travis Mills Foundation. And Jocko had Travis on the podcast in 2017. And it was just something about the podcast that made me just go like, I don't know what I'm going to do, but I'm going to find a way to get Travis and his organization a whole bunch of money. So our 2018 Expo, which Mike, I think you were at also, I just sprung it on everybody and did a charity fundraiser for the Travis Mills Foundation. We raised $110,000 on that one 40 minute charity auction out of nowhere that nobody even knew we were going to do. Since doing that in 2018, our events company has raised $2.4 million for charities doing that same exact formula. And the only way we raise money is through these charity auctions at our conferences. Like Limitless Expo last year did $550,000 in charity fundraising. So that came from the Jocko spirit. Now, on the other side, because we've done all that, I've got to meet Jocko a bunch of times too, which is kind of cool. But and his business partner, Leif Babin, him and I co-own a jiu-jitsu gym together in Dripping Springs. So I got to be part of them. And so it's been a lot of cool stuff following what he does. But the discipline has just absolutely, we're all disciplined in some way. Discipline worked. I wish I was more disciplined in working out. But I think it's just really just more of a matter full circle of not thinking about like how do I say it? Like, just do the work, basically, is what it boils down to, instead of thinking about the work. And I've had a problem with being in my head a lot. So I think that really resonated with me, just like get up and do the work versus just think about it, if that makes sense. So that was a long rant to answer your question, but
No, it's good. It's good because we kind of dumbed you down like a caveman when we were talking about all that flipping stuff. Now we're getting into the layers of Tarl.
Well, I have a question on that. When you're saying you're in your head just thinking about, you're just thinking about all the opportunities you have and like what you should be doing and not doing anything, or what do you mean by that?
what you feel like doing. So there's moments where what you feel like doing doesn't matter. So you still got to go do it. And it's just like, so take meditation, for example. Like meditation, sure. If you ever did any kind of breath work or meditation stuff, it's about getting back into like focus every single time. Everybody loses focus. Everybody gets distracted, no matter who you are when it comes to like meditating. It's just how fast do you get back on track to like whatever you're focused on. That's all it is. Same thing with like what I was talking about, like thinking in my head. Like I could be thinking like, oh my God, shit, what about this? My default is worst case scenario. I go worst case. We had an incident on Monday with an employee of ours, and I immediately went, worst case, this is going to end up in a lawsuit. I'm going to lose my house. My son's going to turn tricks on the streets, whatever, like that kind of thing. I immediately go there.
Wow.
Right? But I've learned to use it as a superpower to go, not like as a freak out, but more like, okay, that's worst case. What's the likelihood that will happen? Probably 0. Okay, cool. Next worst case. And I've learned to use it as like a planning tool, right? To like plan and attack. So we can set up defenses and offenses and stuff, whatever we got to do it. But my old self would just spiral on the worst case. And so if I'm making sense, I've just learned over the years to use it as more as a tool to go like, that's not likely, but now I know that. So I don't have to think about that anymore. Next.
You sound like you were born to be an attorney. Isn't that the way they always think? What's the worst thing that can happen?
I guess I just, growing up with a very pessimistic father also helped with that too. So.
When you started talking about your journey about buying the wholesaling class, you kind of skipped past the Marshall class that you bought. Mm-hmm. And you almost kind of made a joke about it, but you probably got a lot out of that. Because I remember when I was actually thinking yesterday about this podcast, was actually bringing up Marshall. I don't really know who Marshall is, but I know there's an influence there from the way that you think, kind of getting into what you're thinking about right now and the layers of that. So I don't know what I'm asking more so than what was that class, and as a 20-year or course or whatever it was, as a 21-year-old buying a mental course like that, how did it influence you, and have you been benefited from it since?
That's a good question. Marshall Silver, so this was the real estate, what was it called? The real wealth, no, it was I can't remember what the conference was called. It's a big thing at the time, but the Real Estate Wealth Expo, I think was what it was called. Yeah. And they're all over the place back then. But Marshall was speaking, and he was just the way these conferences work is if you spend, like, spoiler alert to everybody, if your ticket is $50 to $100 and a bunch of A-list celebrities are there, they're going to sell you something. So like, that's really all that is. The A-listers are there as bait to get you to show up to listen to them. And then in between all the speakers that you came to hear will be a bunch of guys that are selling you shit. And that's how you actually make your money, because as a promoter, you split 50-50 with whoever sold on stage. So, but Marshall was a guy in between. So he was a guy up there, and he's probably one of the highest close rates on stage sales, like pretty much in the industry. And what it did for me more than anything was I went from a super conservative, balance your checkbook on everything, don't take risks ever, right? Don't go outside. I was like in college doing ROTC for the military to get a stable career. Like I wanted to be an engineer because they paid over $45,000 a year. Like all these, like I was just stuff that I was like mapping out. Like I was like, I need to have like less risk and make sure I can make money at the same time. Listening to his 45-minute pitch, like there was a moment where he's just like, don't think about it, stand up, get up, go to the back of the room. I'm like, okay, and I get up and run back. It was the most terrifying experience at that time in my life. It was tunnel vision, blurry tunnel vision, walking to the back, knowing that I'm about to get $1,500 when I didn't have $1,500. Like I had like maybe like $300 in my bank account, but I had a charge card that had a $3,000 limit on it. and I just gave it to them. And then they gave me a whole bag of books and CDs. And I fell on the ground outside of the foyer and wrote on my legal pad, "I'm going to be a millionaire. I'm going to be like," and I still have this legal pad. I should go find it. But, cause I just the dam broke basically. Yeah. Right. And the risk taking side started coming out. I was already doing like snowboarding and all that fun stuff, but the risk taking in finance came out, and it went pretty extreme until it got more level later. But that's the biggest thing it did for me. Now, of course, his course and going through all that, Marshall's actually become family friends of ours. Like, we know his family, his kids really well. They've become very close to my wife and I. And he's actually the reason why Grace and I got married, because years later, I think it was 2016, 2015, something like that. He's actually the reason the events company started too. Mm-hmm. Now, this is like not because I bought the course. This is 10 years later. Right. I went to the course one time when I was 20. And then 10 years later, I was kind of in a weird spot where I'm like, do I want to keep doing real estate or not? I was like, I wonder what Marshall's doing these days. I haven't been to one of his things in a while. And he said I had a lifetime membership. So I'm like, let's see if it's true. And I went on his website, filled out the thing, and I'm like, hey, I bought this thing 10 years ago. Could I come to another one? He's like, yeah. Or his staff did. And I brought my wife, and I don't want to get into the story for time's sake, but like basically like us going back to that, and becoming friends with him is one of the reasons why Grace and I got married. And it is 100% the reason the events company even started. So was because of 10 years later with Marshall. So I can keep talking about it. But
well, when you say he's the reason you and your wife got married, like, what do you mean?
So I'm not my wife's first husband. So but I'm her, as far as I'm concerned, her most true love, right? And she equated marriage as divorce, right? So like the concept of marrying me meant we would break up later. So therefore, let's never get married. And so, and Marshall had a similar background. And so he basically, she went to go talk, microphone in the crowd, right? And she wasn't even talking about us. But then he all of a sudden is like, hey, so why don't you want to marry him? And then she like stops and like she starts crying. Because nobody said that. I'm like, oh shit, she hated her. He's really good at like reading people, basically, extremely good. And so she just started talking about it, and then he related to her and all that, and got her to break her walls down. Basically, that marriage doesn't equal divorce, right? Like, and that opened her to the opportunity of that. And then probably about 2-3 months later, we were in Montreal, and I'm like, okay, are you going to go see anybody else? No. Am I going to be with anybody else? No. So why don't we just get married? And she's like, okay. But it all started with Marshall triggering that, and we actually met with him in San Diego probably a month later, and they talked about it more, and that helped her like get over it. She wasn't even aware she had that block, but she did. It was very real. So
that's a great story, man.
Yeah,
this is a very good story.
But what's going on with the real estate market? What are you guys talking? You want to talk about real estate?
Yeah. Tell us what's going on with the real estate market.
What are you doing right now? Why are you doing deals in Savannah? Who does deals in Savannah?
Losers. I don't know. But so our deals in Savannah have done all right. They've done pretty good to a degree. But there was a stall for everybody, not everybody, but most markets. There's been a stall, and it started last year. So the properties that we did before the stall were fine. The properties that we had let's put it this way, the properties that we bought on purpose to be a burr, totally fine, no problems. The properties we bought on purpose to be a flip, they suck. So for lack of a better word. And stuff, it gets stalled out longer and holding costs and everything and blah, 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 blah. So Savannah was a good pick for us at the time because Savannah was a small town in the South-ish that was growing and had a massive job demand due to the port there was expanding and had expanded. And Hyundai had built a huge battery factory there that was hiring like 13,000 jobs. And there was a lot of demand. But like Portland, like Seattle, like San Francisco, like other parts, it was landlocked in a sense. You can't build more. So if you have a lot of demand, and this is key to everybody listening, supply and demand is the number one factor that controls all single family real estate. And if you have a bunch of people moving into an area, but the supply can't expand, it has to either tear down something to build something up, or it inflates in prices, right? So Savannah was like, I'm like, that's going to happen in Savannah. And so we went there. And with the intention to keep, not to flip, made some bad decisions to go like, well, while we're keeping, why not throw a flip in every now and then, right? And then but there's also confirmation bias on my side there, because I kid you not, Mike, if you closed your eyes and transported to Savannah and some of the neighborhoods there, you'd think you're in Portland or Tacoma, Washington, or Seattle, because all the houses are the same. They're all 1910, 1920. And I'm like, I have a rental in Savannah that is the exact same freaking house as a rental I have in Tacoma, like the exact house. So I'm like, to me, I'm like, oh, I've done this for, I don't know what, 15 years in Seattle, right? So I'm like, we can do these with our eyes closed. And my misjudgment, though, is I had assumed that construction costs was cheaper there than it would be in Seattle or Portland or something like that. Not true. So and it's not true, because even though it's in the South, and even though it should be cheaper, it's also a low supply of quality contractors in the area too. So like, it's a small town still technically. So the contractor pool is limited, and there's a cartel of some of them that all jack their prices up because they know everybody jacks their prices up. So that kind of like took us by surprise on rehab costs for sure there, but still good portfolio, good stuff. A couple bad duds, lost $90K on one of them, which that sucked. But then we have one that was like looking bad, but the appraisal did really good. So we got some money out. And then we still have one dud that we're still dealing with right now in that area. But then Bentonville, Arkansas was the same kind of situation, a lot of demand. Walmart was forcing all the jobs to come back and stop being virtual. So we thought we'd jump in that. And then Austin, Texas is one of the leading crashing markets in the U.S. Is from peak. So if you rate it from April 2022 to today, right, it's between number one and number two of the top markets that crashed in the U.S. And I live there. So I was avoiding that area for a long time, but I bought a couple duplexes here and there just because they looked all right and whatnot, and they were fine. But now I'm only focused on Austin because I feel like it's crashed enough. So, and now what's funny though is it's still crashing, so maybe I have to wait a little bit longer. So
you're catching a falling knife.
Yeah, I mean, but dude, I'll give you an example. Like I bought one that the tax assessed value, because Texas is very quick to assess taxes and charge you very, very much. Was $480,000, but I bought it for $205,000, right? As an example, right? So I had another one that was tax assessed at $520,000, and I bought it at $285,000 as a foreclosure from a hard money lender from another investor, right? So like, but even then, you got to be picky because like it's just, and the difference is people have equity even if they're still losing it, or they want to sell it, so they don't have to sell it. So there's a lot of forced landlords happening in Austin. The problem on the other side is that there is an overabundance of multifamily that has built in Austin, that are still building in Austin. And so you have 3-4 month rent concessions throughout most of the city, and which is compressing rents. There's a duplex I bought where the rent was $1,500 a month. That's what we comped when we bought it. 5 months later, it was a big remodel. 5 months later, when the remodel was all done and everything, and we were stabilized, refinance is done, everything's done, I think we're going to be lucky if we get $1,300. So it's gone down that much in like a few months. Section 8 is all resetting there dramatically. I have a friend of mine in Austin that has about 120 Section 8 single family homes, and they are basically like offering free foot massages to tenants to not move out, kind of a thing. Because Section 8, if you guys aren't familiar, is you have to, if you get a new tenant, they get a new coupon basically for whatever that is, because it is based on the new market rents. If you try to raise the rent even $1, it resets as well. So they had that on accident where they had a $2,100 a month rent on a tenant for Section 8 that had a coupon, but then they went to go raise it to $2,150, and Section 8 reassessed it down to $1,700. So and just like that, and they're like, we can't do that again. Like, so they've been, and every time they lose a tenant because they want to move out somewhere, they're now getting their rents cut by $300, $400, $500 a month on each unit. So,
oh man, that's scary.
Oh yeah. So, and if you don't own those, you're looking at them going like blood in the water kind of thing too. So
absolutely,
it depends on how you see it. So,
so when you say you're focusing on Austin, are you focusing in that 1 to 4 unit world of distressed assets and?
Yeah, 1 to 4 units, same old, and distressed assets. Because multifamily, that's a business, and it's not my type of business. It's also very challenging for somebody with no experience in multifamily to get funding for multifamily right now. So you have to start partnering with people to figure that out. So, but yeah, 1 to 4 unit, absolutely, all day. There's also just like Portland, there's an ADU play there. So you can do, they allow you to do condo regimes on ADUs in Austin as well. So pretty much any property that's a zoned SF1, 2, or 3, you can put an ADU on it as long as it meets a couple guidelines. It's way looser than Portland and Seattle, actually.
Yeah, there's some cool neighborhoods in Austin where there's developers doing what we do, keep the existing house and build 1 or 2 units around them and condoize them, and they fit into old historic neighborhoods and they look good. They sell for a lot of money down there.
Totally. Now what's happening though is you have to build the ADU to not just be like some small little ADU, because just people won't buy it right now. So it worked really, really well before the crash. Right now it's a challenge, just because if you had the option to buy, if you had $400,000 to buy a house, you're going to go buy a house, not like somebody's neighbor's backyard house kind of thing. So there's so much options there.
Yeah, because it's relative.
That's right. Bad time to sell an ADU, good time to build one. So
you're one of the first guests that we've had on that actually called it a crash. Can you talk a little bit more about the last 4 years of real estate? Because I keep saying this and I feel like nobody really agrees with me, but this seems almost in some ways in the world that we live in multifamily, it's worse than the '08 crash that everybody generally considers the crash. This feels in our world worse than the great financial crisis.
So I got to be very specific here. This is where I say Austin crashed. Mm-hmm. So real estate is local. So there are markets in the U.S. that the market has not crashed at all. In fact, it's gone up right now. So unlike
like
the DFC,
Savannah,
Savannah stabilized. It didn't go. It's gone up, but it didn't crash.
Boom,
but it didn't go up as much as I wanted to. But there's plenty of other places that are doing very, very well. Keep that in mind. Multifamily, no, that's not at all the case. So, and multifamily has absolutely crashed, and multifamily has crashed. And depending on how you look at it, yeah, it could be worse than the GFC, and it's still on track to keep happening. So you have this debt wall, this $1 trillion debt wall of private debt in multifamily that is maturing right now, or has already matured and is defaulted right now. So if anybody bought a 2021 multifamily as a value add at that time, a lot of them, just to get the deal done, did a bridge loan, which is about 3 years for the most part. Well, that's already defaulted, right? You're on to year 4 or 5 right now. Some of those people had a 5-year bridge, right? It's coming up. And so that's the $1 trillion debt wall that we're talking about here. And in that case, right, what happens, because of multifamily is dictated based off cap rates and so forth more than anything, based on your NOI and cap rate, blah 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 blah. If your debt payment was at 4% and then it went up to 8, right, and stuff, because it turned, or it wasn't fixed debt or whatever, right, you can't get out of it now, because now your NOI has dropped dramatically, but also the cap rate locally has also gone up dramatically, and now you went from a $50 million building to a $20 million building overnight, right? And you might have done everything right, but couldn't control that. The only thing you did wrong, or somebody did wrong, was having not fixed debt, but either a bridge debt or flex debt of some sort, or adjustable rate debt, and now you're stuck on it. And so there's properties that are fantastically well operated that are completely upside down. There's people that have fixed debt that are cash flowing, but they just can't sell it. They owe more than it was worth, but they can weather the storm. And unfortunately, there's a tremendous amount of people and investors out there that are stuck in deals that are not only just upside down, they're also negative NOI, net operating income, and they're upside down on the mortgage and blah, blah, and all the way down across the board. So there's a lot more foreclosures coming, a lot more.
You think you'll jump into multifamily with that opportunity?
No, but I'll watch. I'll watch it though. So,
you can't get enticed out of
this, so,
in there.
No, because you got all right. So all right, I'll give you a story. He won't care at all if I share this because he said it publicly. But my partner at the Limitless Expo is Ken McElroy. So Ken McElroy just merged so that he didn't sell. So they've merged with another company. They now have 50,000 multifamily units between him and his partners. and called the Founders Group now. It's an awesome thing that they're doing. They are looking at deals like crazy right now, right? And they get offered all of them. So all the properties that are out, there's properties that here's what happens. If a property is suspected of potentially going default, case in point, in multifamily, there's a thing, I can't remember what his term is, but you do this, even with us, like if you guys have a DSCR loan with a community bank, there's a certain DSCR ratio that you have to, debt service coverage ratio that you have to maintain, or the bank can do some shit, right? Basically, right?
Capital.
And so, to a degree, and I'm talking about the bank, right? Yep. So, I have a loan with Red Canoe in Washington. I have a couple of commercial buildings, right? They want a 1.2 debt coverage ratio maintained always, pretty much. Every year, even though it's a 10-year fixed rate note out of 25-year AM, every year I have to submit all my financials to them, right? That's part of what the note says to do, right? And so, but if they're starting to see that the property is going down, everything's going down, they don't have to wait. They can do some stuff, right? So that's the same thing with multifamily. Ken was saying the other day that in Texas, there's over 1,000 multifamilies currently just in Texas alone that are at a 1.0 debt service coverage ratio. That means that they're upside down, basically, because they can't. If you're at a 1.0 on a multifamily, then you're at negative net operating income for sure. You're not making money on those things. The banks immediately put those people in some sort of default, even if they're making the payment. They're at risk of default. They put them in it's called a special default group of some sort.
Special assets.
Whatever. Yeah, special assets. Yeah, and so, the term's better than I do. I'm just a fly on the wall watching this stuff. So when that happens, those quote quote deals start getting passed around, right? So guys like Ken, they see all those, they get sent to them. The banks start reaching out, trying to shop it. They start getting broker opinions. They start going, okay, what happens? And if they start defaulting, then definitely guys like Ken see these deals way in advance, right? And what's happening right now, he's talking about a deal in San Antonio that was just built, and the cost to build was something like $40 million, let's just say, to build it. It's being offered at $10 million right now. And it was just built 2-3 years ago, but it's got a 5% occupancy currently, right? And so you sit there and you go okay, you're going to take this asset on. You also don't know what state everything is in, and you're going to be at negative cash flow for 2-3 years, getting it leased up and taken care of, not to mention any kind of CapEx reserves. So sure, you can go buy that, but it's going to be just a horrible time for years, right? Before it starts to actually do anything. So you have to be pure negative right away. Do you want to take that on, right? As an operator, right? So is the other thought process. So that deal is going to sit. It hasn't even sold yet. So, and it looks good on paper, but the experienced guys don't want to touch it, because then there's all these circumstances that are going on right now. It'll get cleared up over the next 2-3 years, right? But it's going to leave a bloody path as it's doing it, depending on what side of the table you're on.
So how does an operator with 50,000 doors, they're obviously looking for blood in the water, so they must feel pretty good about the portfolio that they have. They're lower levered, or they've owned them long enough to where they're not as concerned. They're in a position to strike.
Well, you don't really care about your equity if it cash flows during a down market. You only care if you're going to sell, right?
Or the loan comes due.
Yeah, totally, right? So that's where the fixed debt comes in. So if you're secure with fixed debt and you got and everything's tied in great and all that stuff like that, you don't really care as much. I mean, you might be looking at it, but you're not caring as much. So it's at that point, he says all the time, it's right now is the time to buy, right? Later, if the rates come down, that's the time to refi, that kind of thing. So, but we literally just did a webinar on this for 3 hours a couple weeks ago about how the Fed is not your business partner, and how a lot of people are building their entire business plans around what the Fed's going to do. And a lot of multifamily and even single family guys would love that the rates to go down, because it'll bail them out from stuff that they bought years ago. That's true, right? There's properties that I have that would be great if the rates went down, but at the same time, rates go down, it's gonna be harder to buy. And so my future self might not be as excited about it when all of a sudden I'm like, man, I had an opportunity to buy a bunch of properties and I didn't. Because it's counterintuitive when everybody's terrified of something to jump into it. So I get super nervous looking at some of these deals in Austin where I'm like, man, what if it go down more, right? Should I wait a little bit longer? Like, I still got the fear, even though I know it's a great time to buy stuff there. But that's what's happening with multifamily too. Like, is it going to drop any further? Most of my experience just comes from talking to the guy. Like Jay Scott's a good buddy of mine. Like, he has multifamily, but Brian Burke, you guys should have him on here if you guys haven't talked to him yet. But all these guys are also like, I think there's more to go, right, with multifamily. And Ken talked about this on a thing we did. He also said on his YouTube channel a few times about how he had a sweet freaking deal. He bought $500 million last year in multifamily, just to be clear. But he was supposed to buy another like $50 million deal. And while it was in escrow, the NOI dropped like 20%. A bunch of stuff happened, right? The operation started going south. That changes what the property is worth in the middle of escrow. So all of a sudden the bank was like, hey, we're going to lend you 30 million. And then the NOA drops. And then he's like, well, now we're only going to lend you 25 million. Now you go in the middle of escrow, right? So what do you got to do? You either got to have to renegotiate the deal
or raise more capital.
Or raise more capital, right?
On a worse deal. This deal's falling apart. Deal. Put more money in, guys.
Less leverage.
Exactly.
Less income.
So a deal. I remember him being so excited about this property, and then they had to back out because like it was still had more room to go, right? And there's more room to go. So the debt wall is a big deal right now because I don't know what that's. I really don't know. It's all speculation. But what is that going to do to us? Single family investors? Like, is it pretty much like the way that I can think about it is like if you had the homeowners don't know about it, like all the regular conventional people, the normies out there, they have no idea what this debt wall is all about because it's not affecting them, right? But it could affect them because a lot of that debt and a lot of that notes are bought by 401k, asset management companies that are like your pension funds and mutual fund companies and things like that have bought a lot of these notes. And BlackRock's already announced it's writing down a bunch of these things. There's a bunch of things happening behind the scenes. And does it trickle to the middle market? It absolutely could, right? And it definitely can in a lot of ways. It's going to make, for sure, it could take a few banks out. That's for sure. Like, hopefully it's not your bank, right? When that comes out, that can absolutely happen. And it's just all speculation right now. But people are trying to kick the can, but it's already been kicked for 2 years, and now it's coming due, right? And when it hits in 27, right, and the rest of this year, the only thing I'm concerned for myself is that it's the bank I'm invested in. Are they going to be affected? Like, that's how I think about it, right? We have loans. We sell loans and whatnot because of our hard money companies. Like, which one of these places that we place paper with are they not going to be around because they have too much paper with so and so? There's a bank I'm very seriously like into right now. They're out of New York, and I was doing some research on them the other day, and I didn't realize that like they were the largest SBA lender during the EIDL loan stuff, and a lot of those are defaulting. There's a bunch of things that are going on there, and then they're a massive commercial lender for multifamily. I'm like, I keep talking to these guys or not. So like, no, they're gonna be fine. They seem really smart. Yeah, right. And so they seem pretty legit. But, like I've been doing some stuff with them for a little while now. But those are like just the worst case, right? I was talking about that earlier. I'm like, okay, worst case. What do I do? So I can't go have a bank that I have my money in go belly up, right? I can't take that hit. So you know what I mean? So anyways, sorry,
Dude, you got like a liquidity crisis going into our brains right now. Why did we invite you on?
To hear the worst case.
Is this how you sell tickets to Limitless?
All your money in gold. And pray. Yeah, so like, you brought it up. Limitless is about, the way that we kind of look at it is that it's like, how do you create certainty in uncertain times is really where we're at, right? And the only way that we can figure that out is to talk to more smart people like you guys, right? And how do we get in a room with not who has the biggest social media, but get in the room with who's actually on the ground doing stuff, who's actually seeing it from the trenches and actually like involved, not just real estate. It's all business, it's all finance, it's all macro, it's all alternative investments, and real estate's definitely a huge component, but it's really like what's in the horizon and what do guys like Ken think, right? What do other operators think? What do business owners think? What's gold think? What's oil think? What's going on with her, all the oil crap like that's going on out there? Like, what's that? How's that going to affect us? So it's a lot of that, right? So that we can determine what's best for us individually, for us and our family. That literally is what Limitless is about. And so no sales from the stage. We don't sell courses like the one that I went to that got me into real estate. It's just pure B2B. So that's why we do it.
Who's your charity you're raising for this year?
So probably the same two. I always hold back announcing it until we get closer because you always change it. It's kind of, I don't want to say this out loud, but I'm going to. It's kind of like feeding stray cats, right? Like sometimes like they expect you to keep raising for them every single year. And sometimes it's hard to go like, I got to give somebody else a chance.
Yeah,
but
absolutely.
But now you're part of their, revenue for the year. At least that's how they pencil it. And some of them are very, very good at making you feel very, very bad if you don't do that. So, but that said, we've been raising for America's Mighty Warriors for a long time. For the last, this will be the 5th year. That's Debbie Lee, Mama Lee. Her son was killed in Iraq. He was the first Navy SEAL to die in Iraq, Mark Lee, in action. And so Gold Star family, she does a lot of stuff with that. And so we've been raising for her for a while. We took on another charity last year to do a double charity, Beyond the Brotherhood. And that's another organization. So it's all military based typically, but where we can have that. And we prefer to raise for organizations that absolutely like $300,000 would change everything for them. So kind of situation. There's organizations that are out there. Like I love Travis Mills. He's actually a very, very good friend of mine. But his organization is at a point where $300,000 is just another $300,000 situation. And if he heard me say that, he'd probably get super pissed. But but it's a absolute, like, it was, for instance, what we did for Beyond the Brotherhood last year, between everything we did for them was $350,000. That was more than their entire year, like that they ever had to be able to operate with what they do. So it was a massive, massive, massive. That's what I'm like, who can we help in that situation? So we'll probably be America's Mighty Warriors and Beyond the Brotherhood again this year. And there's another organization I really like a lot, Stronghold. But we don't need to get into them. They're great, but we'll probably do something for them one day.
You, I believe that you mentioned you were on the path to ROTC early in life. Is that why?
Correct.
Is that why you're military focused on your charity work? Is because you went to the devil and went into real estate?
I decided to go to capitalism. Yeah, it's not Catholic guilt; it's capitalism guilt.
Yeah.
So there's a massive element there. I grew up around a lot of military. My dad was military. I had a lot of friends that are military that went military straight out of high school, right? And it's interesting. I grew up in a lower-ish, low middle kind of area. A lot of people went to military from that, so I have tons of friends. So for me, I was going to go straight through, right? I'm going to say there's a really freaking funny video that every Memorial Day is like that somebody posts, where it's just like, let's not forget to honor those that almost served, right? And I don't want to go down that right now, but basically, I almost went directly in, right? But like, my dad's the one that convinced me to go to college so I could become an officer instead. And I was full, like, I'm going straight in, and I was going to do pararescue. That's really what I wanted to do. And but my dad actually stopped me, right? And he literally convinced me through a series of conversations to go to college so I could become an officer. And I'm like, what do I got to do? He's like, ROTC. I was just a walk on. So I did that for 3 years straight, and I loved it. And then because of Rich Dad Poor Dad and going to that one, I went to that sell-a-thon place because I wanted to see Robert Kiyosaki talk. That's the only reason why I went. And while there, I bought Marshall Silver's course. And while there, like, it just like derailed everything and completely. So if I didn't go to that, I would have absolutely commissioned as an officer. But where I got fortunate is that, it will depend how you look at it, but that was my junior year. And so you kind of are committed once you're in your junior year, but they had a lot of second lieutenants coming into the Air Force back then. And so they basically gave pretty much everybody, for the lack of a better word, an out if they wanted to get out. So I took it and started trying to go make money. I'm friends with a lot of my college buddies still. A lot of them retired now. I'm 41. A A lot of them are now on their 20-year mark and have recently retired. Some stayed in, some got out a while ago. And it's all like, whatever. They all like, I wish I did what you did, right? I'm like, well, I wish I had some of the experiences you guys had. Like, so it's all grass is greener.
Yeah, it's trade-offs.
Yeah. And there's absolute, I still hunt for that brotherhood kind of aspect, which is probably why, I've done the volunteer firefighting stuff or the EMT stuff, and I've done the ski patrol stuff, but a lot of that's trying to get that, like, where's my click? So I created it with the Maui Mastermind, right? Like, that was one way to get a click, right? Whatever, but I've always been searching that, like, community. So the only way, I think that's why I keep building events and around that in community parks. I'm always looking for that, like-minded group. But even the jiu-jitsu, that's why I'm super into jiu-jitsu, is because that's a community that all love choking people. So, like, we absolutely get along, right? So, but then I like the community for real estate and business, right? So that's why we do Limitless and, Maui Mastermind and all that kind of stuff too, right? And so it's, where do you get your kicks, right? Is really what you got to go build your community around. And so, yeah.
To me, it sounds like you've done a really good job at, like, staying in your lane and not getting distracted. How are you able to do that? Because you're meeting so many people doing so many things, and I would assume it's really hard to, like, look at Ken and be like, oh, that's really cool what he built. I want to do that.
Yeah, I've never thought that once, to be honest with you.
Really?
I'm not saying that. Yeah, not one time. Yeah, I see the opposite. I'm like, wow, I don't ever want to do what he did to get what he has, right? So I more see it that way. Because I'm like, how do I get what he has without having to do what he did? Kind of thing, right?
Yes.
But it's all. So 2017, I had a major burnout, like super duper burnout, and there's a lot of stuff I put out on this over the years, but like, I did more volume, more revenue, more houses, more everything. I had more operations, more staff in 2017 than I did in 2016. On paper, everything was better in the company, but I made less money, right? And because we had more operational costs, right? And the machine had to be fed, so I had to keep doing flips. We had to sell a property that I didn't want to sell because it had to feed the machine. I wanted to keep it. And it started, like, really, really getting to me. And then, we had our first expo, and just everything was just chaotic. And so I burnt out pretty bad. And Thatch Nguyen, my buddy, basically said, hey, most people build their business first, and whatever life they have left over, they try to fit that. Why don't you go figure out how to build what you want in your life first, then force your business to do that? And that was October 2017, and completely revolutionized everything I think about. And I went from, like, just waking up and just working and not having any direction. I was just like, I'm supposed to go make more money. That's what I'm going to do. We're going to go make more because that's what you're supposed to do. To why am I doing this? What should I be doing right now? Like, it basically, instead of like, what should I do? It changed to, should I be doing this? And it was a whole like shift change. Like, should I do that? Should I be the one that calls that person? Why am I even flipping? I had 23 projects going on, right? And I'm like, why did we choose that number? Like, why did we do it? It's all because of the more. But all more did, when it comes to, like, if you're just doing more doesn't mean freedom later, right? Like, unless you're building in that direction correctly. I built a prison, right? I didn't build freedom I didn't scale up to some sort of great, awesome thing where, I have all this freedom and money. No, I scaled up to a freaking prison that, like, if I didn't keep working, then I got killed, right? Basically. So, like, and it was not a good time. So I had to rebuild it and rethink through with purpose. And a huge portion of that was developing lanes. Like, what is my lane? What is my wife's lane? What is Serena's lane? What is Nate? All these people on my team. And then not only just that, but where are we going? Like, what is the whole point of all this? And for me, the whole point was freedom. The whole point was freedom, option, choices. It wasn't 50 freaking houses that I had to go flip. It was freedom, option, choices. So what does that mean to me? I don't care about private jets. It's kind of cool to ride on one every now and then, but I don't need to own one. I never wanted to own one. I wanted to go travel 6 months. I wanted to go do cool stuff. I wanted to go on heli-skiing trips. I want to go, like, have those experiences. I don't need to have 10,000 doors to do that, right? Like, and at all. Like, and so I've never cared about cars. Well, that's not true. I did when I was 17, but I don't care. Like, it's just I care about, like, the trip I'm going on. I care about the experiences I'm doing. I care about the people that I'm around. But I more care about like when I wake up in the morning, am I doing what I'm doing that day on purpose, or is it on accident, right? Like because I'm reacting. So I was in a reactionary life for years. Everything was just go, 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 to where I just started turning into more like a purposeful life, where like I'm doing this for this purpose, and that's what I'm doing. And that's, we went from, buy as many houses as possible and have no limit to 10. We do 10 at a time. That's it. We just restricted ourselves, right? And then we got tighter on stuff and whatever. And that was just a business decision, but also it was more of a life decision. So even to this day, like when we started the lending company, I was like, we're doing this much volume, that's it, and we're only building to this level. Like, and that was it. That was a choice, right? Because I knew if we wanted to build more or grow, we need staff and people and all these things. We slowly grew over time, but everything's just like, how do I do it on purpose? Does that make sense?
Mm-hmm.
What I'm trying to say? Instead of, I went through the accident. I went from 2010 to late 2017, doing everything just reactionary, right? Wake up, fires everywhere, contractors everywhere, shit going on everywhere, right? Drive, get in the car. Oh my God, we got to go here. This happened here, right? We're going to meet with the city over there. Oh, like there's a wholesaler. Let's got a deal. Let's go over there. Like you guys have been doing this. Mike, I know you've done this. Like it's just like, it's just what it is, right? So to where like, okay, do I have to be the one that does that, or can somebody else? Can I do it over the phone? Do I have to like start doing it on purpose? So that's the answer to your question. The long way is that there's a time. The goal was for me was never to not work. And that's not the goal. The goal is to work on what I want to work on, right? That's the goal. So hope that I'm making sense and all that.
Yeah. So do you see yourself like just maintaining what you have going now, or do you have some other picture of what you want to do next?
So are you guys familiar with the word ego? Like, have you guys heard that? So 2023, I didn't do anything. Like we ran Limitless, and my lending was like bleh, just because the rates were kind of crazy. I didn't buy a single property. But I had a lot of time to think about all the cool stuff I could be doing. And I think that was a bad thing because the ego got in the way to go like, well, I can go build up all these businesses and I can go do all this because I had a lot of free time. And so I'm like, okay, we're going to go scale. But instead of scaling one business, let's try to scale 3, right? And it all made sense on an Excel spreadsheet. But then when you start actually when I started interacting with it and stuff, what I learned in 2024 was just like, okay, I can't do that. I need to do one business at a time. And it's taken me a couple of years to figure out what I want to be when I grow up. And what I found, right, for myself, it's actually better for me today. 2 things. I need to make a certain amount of money every month, right? We all do, right? So, and now, sure, I have rentals and sure I have stuff, but I spend a lot of money. I don't want to admit that, but I do, right? My family enjoys it. We like to go do fun stuff. And we can die tomorrow. So everybody says like live with, die, there's that book, Die with Zero. Mm. We have no problem with that. We can totally go with that around there, right? But I wish my wife and I were, one of us was like the counter to each other. We're both the enablers of each other. But but I'm not saying we're worthlessly spending. We're pretty legit. But at the same time, we're not like diehards. So what I mean by that, so we have to make a certain amount, period. So if I'm not flipping, how do I make that money? So if I was making, let's call it 30 grand a month. If I have to make 30 grand a month just to like live, then how do I come up with that 30K a month, right? That means I either have to flip, I have to go do another business, I have to go get a job. I'm never getting a job. What job would ever pay me 30 grand a month? Anyways, all this stuff. So I got to go figure that out. And my rentals could pay a certain amount to a certain point, but then you got insurance is going up, property taxes are going up, all this stuff, it starts compressing, rents are compressing. So our cash flow has gone down, right, in certain levels. So, and buying $200 a month doors takes a while to get to 30 grand a month, right? So and that's if everything goes right. So that point, yeah, maybe the 10,000 units would be really good for a multifamily. But what I'm getting at, the long answer of it is for myself, my goals is like, it's taken me a very long time for self-identity to go, okay, I have a very strong business, which is my events company. That pays me a salary. Cool. Right. I have a very good lending company. That pays me something. Cool. How do I make those businesses work well? So the money I make, I can just put back in real estate. Right. So my entire business plan over the last 2 years is make active income to put into passive assets. That's it. But it used to be the real estate was how I made active income. That was it. And I'd have to flip houses to make active income. And out of those flips, I would put them into my BRRRRs. Now I'm like, how do I stop flipping? Because, man, I don't know about you guys. Mike, I don't know if you're tired of flipping. We haven't talked in a while, so we're catching up on this podcast. But I just get sick to my stomach at the thought of flipping. Like,
Yeah,
just
put some parameters around it. Definitely put some parameters.
Right?
Mm-hmm.
But, dude, totally, I love buying real estate, right? Like, I think right now is a great time. So how do I solve that, right? Do I raise a fund? Good. But then you're giving 60, 70% of the equity away to a bunch of people and try to make single family cash flow unless you're just buying like a bunch of properties that aren't going to appreciate. I'm like, you don't really get wealthy in single family unless it's appreciating. Spoiler alert. But if you're just doing $200 a month cash flow at $80,000 homes or even $500 a month cash flow, you're getting cash flow. That's all you're ever going to get. You're not going to retire on that. So long story short, we're building up our active businesses, but the only reason why we're doing that is so that we could put it all back in real estate. That's it. So Jay Scott told me to do that 5-6 years ago, and I thought he was an idiot when he said that. So I'm not even joking. I was living in Maui, and he called me up, and he's just like, "Hey, do you want to take this consulting thing for such and such? I'm looking at dude. I'm like, you didn't take a job? Like, I was giving him shit. He's like, it's not a job. It's I'm like,
it's active income. It's different.
Like, dumb. And then and he literally told me on the call, he's just like, Tarl, dude, you could go make money outside of real estate to put back into real estate. And I'm like, no, you can't. So it's just totally like, nah, you're an idiot. And now here I am going like, hey, you can make money outside of real estate.
That's funny. That's the tune lately is you can. It's probably better to make money outside of real estate right now than trying to make money inside of real estate and treat it what it should be, which is a vehicle to store wealth in, not create wealth through.
Flipping was very, very easy. Wholesaling was very, very easy for a long time and to a degree, relative. And so, as we know, I'm still absolutely viable today. Like in any market, you can do it, in my opinion. It's just, I'm just burnt out from it. Just that's what it is. And I don't get excited about a flip. This is gonna sound bad. But we have a house on the market that we can make like 50 grand on if it sells. I'm already thinking about like, okay, whatever, I don't care. When are we gonna get that so we can move on? Because I'm already tired of the house. Right?
Yeah.
And I'm like, we're gonna pay taxes on that too, right? So like all that. Versus I get excited about like the burr that I just refinanced to last week. And I'm like, sweet. We're going to get $300 a month. I get excited about that, right? And but the equity is trapped in there. I'm excited about not paying the taxes, and I'm excited about the storage, all of those things. But I still got to go make money every month, or else I'd have to sell those, and then I would be upset again because it's been doing this for a real estate 20 years, but doing it full time since 2010, and I don't want to have another situation like you said, Dave. About or when you guys said about like regretting selling any of those houses or investing in hindsight of those houses in the past, and I don't want to do that anymore. So that's the big thing.
No regrets.
No regrets.
No regrets. Yeah.
Dude, thank you very much for coming on today, man.
That's
especially
awesome.
With the other conference you got going on and your busy schedule.
No worries. My pleasure. Thanks for letting me talk about my favorite topic.
We'll have to catch up with you in person in August. Is it? Are you guys in Dallas again, Texas, for Limitless?
No, we're going to be in Scottsdale. We're going to be in a much colder place, Scottsdale in August. No, we're doing it at the JW Desert Ridge in Scottsdale. It's the only facility that will hold our size of an event, but it's August 14th through the 16th, and limitlessexpo.com. So you guys can look it up. Everybody look it up. It's pure, how do I say it? It's all operators like us and accredited investors. And it's no selling from the stage, no BS. It's just what's going on in the world so we can create some certainty.
And great networking. Good fun.
Massive networking. That's a big part.
How do people follow you? Get a hold of
Tarl Yarber, TarlYarber.com, at Tarl Yarber on Instagram. I will be posting more eventually. So, but I go in waves. That's where we're at.
Cool. We gonna wrap it up?
Yeah.
All right, guys. Hey, Deal Junkies, if you want to book a call with us, dealjunkiespodcast.com. Tarl, thanks again for being on the show with us. That was super fun to hear your story. I'm kind of jealous because you rattle off all these names of heroes of mine. I'm afraid to meet my heroes, but Mike Nuss and Jay Scott and Robert Kiyosaki and Ken McElroy and how do you pronounce it? Thatch Nguyen?
Thatch Nguyen.
I told Trevor. He asked me who's my number one guy. I said that's the guy I follow on it. I love that guy.
Awesome. Yeah.
He's so cool.
You'd love that. Thatch is who he is on Instagram and in person.
Dude.
And then Ken is who he is on YouTube and in person. I would say, like, when you meet your heroes, like, case for it, I met Jocko. I don't think him and I will ever be real friends, but his business partner, Leif, we're bros.
Yeah.
Met Robert Kiyosaki. I don't think we're going to be friends, but his partner, Ken McElroy, or whatever, super close, right? Like, so it's just, it's interesting how it works.
That was, I think, the first real estate book I ever read was The ABCs of Real Estate Investing by Ken McElroy. It's a simple,
book I would refer
the
to
simple
people.
little 101 on what you're getting into.
Yep, that's actually where I think, because Robert Kiyosaki got me into it, but him being the author, Ken McElroy, is where I actually feel like I got educated.
Yeah, that's cool. Well, Tarl, thanks again. I hope we can do it again. Maybe you can help us get some of these guys on the show with us. That'd be fun to talk to them. We'll meet our heroes.
Let's go.
All right.
We have a podcast stage at Limitless. Just bring your, just show up.
All right.
There we go.
Let's do it.
All right.
All right, guys. Hey, Deal Junkies, we love you. Please share us with someone you love, and we'll see you next time.